Welcome to this explainer. We've got a really fascinating business case to dive into today. We're looking at Old Dominion Freight Line. This company is basically the ultimate test case for how to handle macroeconomic cycles. Think about it. What actually happens when one of the absolute highest quality operators in the entire transportation sector slams into a sluggish, cooling economy in 2026? Well, it creates this brilliant paradox of excellence. And we're going to unpack exactly how that works step by step.
So here's the high-stakes puzzle we're trying to solve. Can a perfect company survive an imperfect market? It kind of gives you some cognitive dissonance, doesn't it? Because on one hand, you've got this company with a totally pristine, dominant track record. But on the other hand, you're staring right at the turbulent, completely unpredictable reality of the 2026 freight market. A lot of times, people just assume a best-in-class company is somehow immune to economic cycles. But as we're going to see, freight demand still makes the rules.
All right, here's our roadmap for the explainer today. We're going to start with the best in the business, then move into the freight cycle reality, check out navigating the downside risks, look at opportunities for a rebound, and finally wrap up with Wall Street's great debate.
Okay, let's jump right into Section 1, the best in the business, establishing the premium juggernaut.
Before we talk about the current cycle, we really need to understand the sandbox Old Dominion plays in, which is LTL, or less-than-truckload trucking. Basically, this is a shipping method where goods from multiple different shippers get combined into one single truck network. You know, it's not just filling a trailer with one customer's stuff and driving it from point A to point B. It is incredibly complex logistics. It's like a giant moving puzzle of combining, routing, and delivering shipments. And Old Dominion? Well, they've mastered this puzzle better than pretty much anybody. They built that mastery on some rock-solid historical advantages. We're talking disciplined pricing, absolutely incredible network density, elite service quality with a super low claims ratio, and just ultra-tight cost control. The really crucial thing to grasp here is that their success, all those compounding earnings and expanding margins over the years, it wasn't built on, clever financial engineering. Not at all. It was built by just doing the fundamental basics of trucking flawlessly. They proved that in the LTL space, being reliable is a literal ironclad competitive advantage. Which brings us to Section 2. The freight cycle reality, or, as I like to call it, the 2026 plot twist. Because look, no matter how beautifully you build a ship, you can't control the ocean's tides. When industrial production slows down or retail inventories pull back, even the absolute best companies are going to feel the waves. Just look at this stark reality check, $24. That's roughly where the stock is sitting to reflect the 2026 reality. That is a massive drop from its prior high range, which was up near $233. Now, despite that huge drop, the market isn't pricing it like a distressed company. It still gets a premium valuation because of that top-tier status. But seeing that number really grounds us in how much more selective the market became when freight conditions cooled down. To understand what's happening under the hood, we have to look at a super important industry metric, the operating ratio. This is just a company's operating expenses represented as a percentage of its revenue. And in the trucking world, lower is always better. It basically tells us exactly how much it costs the company to generate one single dollar of sales. I'm bringing this up because it is the perfect way to understand the internal financial squeeze a company feels when their revenues start dropping.
And if we look at the actual Q1 2026 numbers, you can see that exact squeeze happening. Revenue declined year over year, shipments per day down materially, tons per day also down. And because of that, their operating ratio worsened to 76.2%. Why does that happen? It's because of a concept called overhead deleveraging. Basically, when shipment volumes fall off, you've still got to pay for the physical terminals, the tech systems, and your base labor force. So you're bringing in less revenue, but your fixed costs are still sitting right there, which directly hurts that operating ratio.
All right, let's move into Section 3, navigating the downside risks, a clear-eyed look at the bear case.
Now, since this is an elite operator, the risks we're talking about aren't about bad management. They're almost entirely external. It's really crucial to understand how these 2026 risk factors are all interconnected. First, weak LTL demand, meaning shippers are cautious and industrial activity is slow. That feeds directly into that operating ratio pressure from fixed overhead we just talked about. Terminals don't just magically shrink when the freight vanishes, right? Then you've got competitors who might start panicking and abandoning their pricing discipline, slashing rates just to keep their trucks moving. Throw in inflation across labor, fuel, and real estate, and you run the risk of the stock's premium valuation compressing. Even top-tier quality doesn't fully protect your stock multiple from shrinking.
Now for the flip side, Section 4, opportunities for a rebound, the elite network advantage.
Yes, Old Dominion isn't a cyclical industry, but they are far from an average cyclical company. They've spent decades building an absolute fortress of a national network. Think of these rebound catalysts like a giant rubber band. Right now, this weak freight market has pulled the rubber band way, way back. But because they have massive operating leverage when freight finally recovers, boom, that profitability is going to snap violently forward. You get more freight moving through the exact same network, so the overhead gets spread across way more revenue. Plus, in a downturn, weaker competitors usually start dropping the ball on service. Old Dominion steps in, uses its incredible reliability to win market share, and leverages that national terminal network that, honestly, nobody else can easily replicate.
And their unwavering discipline is perfectly summed up by just one number, plus 4.4%. Even during that really soft Q1 in 2026, their LTL revenue per hundredweight, if you exclude fuel surcharges, actually went up by 4.4% year over year. So what's the takeaway here? It proves that management is fiercely protecting their yield. They are stubbornly sticking to their pricing discipline instead of racing to the bottom and chasing bad, unprofitable freight just to look busy. You also have to factor in their sheer capital power. I mean, in that exact same tough quarter, they generated $373.6 million in operating cash flow. They used it to buy back stock, and they even raised their quarterly dividend to 29 cents. That is a fortress-like balance sheet. It lets them actively reward their shareholders even while they're weathering a really harsh cyclical economic downturn.
Let's zoom out for a second and look at the macro freight timeline to get some perspective. Back in 2020, we saw earnings surge and the stock aggressively re-rated upwards. Now, fast forward to 2026, freight has cooled off, bringing volumes and revenue down with it. But take a look at the horizon. Forward estimates for 2027 and 2028 are already pointing to an EPS reacceleration. So yeah, the present is definitely painful, but the forward-looking models anticipate a really powerful recovery. The underlying network is completely intact, it's literally just waiting for the volume to come back.
Which brings us to our final stop, Section 5, Wall Street's Great Debate, respecting the company, debating the timing.
So how exactly do financial professionals weigh a nearly flawless company against a heavily flawed economy? Well, if you look at the analyst consensus, it reveals total hesitation. You've got 2 strong buys, 6 buys, and 3 sells. But look at that massive chunk of 13 hold ratings. That perfectly illustrates the dilemma. Wall Street respects the company immensely. I mean, notice there are 0 strong sell ratings. They absolutely know it's a premium carrier. But they're completely torn on when this freight cycle will actually turn to justify buying in at that current premium. Right now, the market is basically trapped in a squeeze between 2 very distinct realities. On the bullish side, there's this belief that the bottom is near and that Old Dominion's elite operating leverage is going to drive a way faster than expected earnings recovery. But then on the bearish side, there's the fear that this downturn just lingers, and eventually defending that premium valuation multiple becomes completely impossible without the underlying freight volume to back it up.
And I think this quote beautifully sums up the central thesis of our whole explainer today. Old Dominion is a premium company, but the stock still requires cycle timing. That right there bridges the gap between the operational excellence of the business itself and the harsh external reality of the macroeconomy. Because at the end of the day, quality alone doesn't completely shield a stock from the laws of supply and demand.
So I'll leave you with this final, really crucial question to ponder. As someone observing these markets, is it better to buy the absolute best company when it's stuck in a bad cycle, or is it wiser to just wait on the sidelines until the cycle definitively turns? It's a profound dilemma about cyclical investing, one that really challenges us to separate a great business from the timing of its market. Thanks so much for joining me on this explainer today. Keep asking the